Kia ora, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This will get everything you need to know in 90 seconds at 9 o'clock with news. Financial markets, regulators and households worldwide are battling the lurking thief that is inflation. And regulators face a stark choice, inflation or recession. The last time Stats New Zealand looked at our consumer inflation level, it was running in March at 6.9%. It is surely higher now. Our June rate won't be known until July 19. And so far no analysts have yet forecast that level recently. The RBNZ's last MPS picked a 7% June rate and lower after that, and that will clearly be way out. Our own Grocery Price Monitor, a weekly service, suggests that June 2022 quarter prices will be 12% higher than the equivalent level a year ago. However, there's more to CPI inflation than just grocery prices. And there are plenty of things to blame, and partisan commentators are choosing them all. But the cost of energy is behind almost all the food, transportation and product price rises, so the most credible culprit, given when the scourge took off, is the Putin tax, outweighing the pandemic effects or even QE. Everything contributes in its own way, of course, but the war shock is the trigger. How to fix the problem? One that steals from wallets and household budgets? If we can't stop the war on Ukraine, we have to quell demand significantly so that price hikes don't stick. The problem is, this remedy hurts. But we see it in action in China. Chinese consumer prices were up just 2.1% in May from a year ago, but of concern will be that prices actually fell from April, a whiff of deflation there. China may be struggling in the real economy with sinking demand, but they still know how to flood new loans onto companies. New yuan loans rose sharply in May, up 11%. In the US, the feared surprise in American inflation has been recorded in May. Overall, the headline rate came in at 8.6%, a 40-year high. But worse, food price inflation came in at 10.1%, also a 40-year high. Markets were expecting a headline rate of 8.3% and food prices up about 9%, so the actual results have shocked financial markets into sizable reactions. Equity prices fell, bond yields jumped, and the US dollar gained sharply. Another likely reaction is that the Fed will raise its policy rate by 75 basis points on Thursday. Until now, the best estimate has been 50 basis points. With that as a backdrop, it's hardly surprising that consumer sentiment there has dived. However, not all data released over the weekend was negative. The remarkable repair of the US federal government finances continues with a greatly improved May deficit. The US Treasury 10-year yield will start today up 1 basis point from this time on Saturday at 3.17%, and that's a 20 basis point rise for the week. Last week on Wall Street, the S&P 500 fell 5.1%. Over the weekend, the S&P 500 futures indicated that when they reopen tomorrow, they will start down another 2.8%. Monday trade may open with a rough tone everywhere, starting in New Zealand, of course. And markets are now also battling a social phenomenon where it is suddenly fashionable to be a market bear. The price of gold was up $23 at the close of trade in New York, now at $1,872 an ounce. A week ago it was $1,849 an ounce. And oil prices a little changed from this time on Saturday, now just under $118.50 a barrel in the US, while the international Brent price is now just over $120.50 a barrel. Both levels represent about a dollar gain for the week. And the Kiwi dollar will open today, little change at just over 63.5 US cents. For the week, that's a 2.2% devaluation. Against the Australian dollar, we're at 90.2 Australian cents, and against the euro, we're at 60.5 euro cents. That all means our trade-weighted index starts today at just under 71.3 and down 60 basis points for the week as the greenback strengthens, and it's now at a 20-year high. Kia ora, I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.